It's 11:47 p.m. Eastern Time Sunday night, January 19th, 2026. While most of America is asleep, a trader in Singapore just paid $104 for a single ounce of physical silver. At that exact moment, the official New York COMEX price sits frozen at 90 Mohar. That's a 13 gap between two markets that are supposed to be trading the same metal. And what's happening right now, in real time across global exchanges while Western markets sit dark, is about to expose the largest structural crack in the silver market that we've seen in modern history. Stay with me, because what I'm about to show you is not speculation. These are documented prices on regulated exchanges. These are real transactions happening right now. And by the time you finish watching this, you will understand exactly why the next 36 hours will determine whether the paper silver market survives contact with physical reality. This is Untold Empire, and what's unfolding this weekend is something that commodity traders have been quietly watching build for months, but nobody wanted to say out loud. Let me start with what triggered this crisis. Tomorrow, Monday, January 20th, 2026, is a federal holiday in the United States. Martin Luther King Jr. Today, banks are closed. The COMEX futures market is completely dark. From Friday afternoon at 1:30 p.m. Eastern until Tuesday morning at 6 p.m. Eastern, there is zero price discovery for silver in the Western financial system. 72 hours of absolute silence from the world's primary silver pricing mechanism. Now, under normal circumstances, a long weekend means nothing. Markets close, traders take a break, everyone relaxes, and life continues on Tuesday like nothing happened. But this is not a normal weekend, not even close. Because three factors have converged simultaneously that have never aligned in the history of commodity markets. And when I show you these three factors, you'll understand why Asian buyers are willingly paying 14% premiums right now while American markets sleep. Factor number one, COMEX registered silver inventory, the metal that's actually available for immediate delivery against futures contracts, closed Friday at 18.2 million ounces. Just 18 months ago in July 2024, that number was 152 million ounces. That's an 88% decline in deliverable silver sitting in Western vaults. The physical metal has essentially vanished from the system. Factor number two, according to the latest Commitment of Traders report released Friday afternoon, there are currently 847 million ounces of paper silver short positions held by 8 major financial institutions. Let me walk through this math with you because it's critical. 847 million ounces of paper promises. 18.2 million ounces of real metal in the vaults. That creates a leverage ratio of 46 to 1. 46 paper claims for every single physical ounce that can actually be delivered. Factor number three, and this is what makes this particular weekend unlike anything we've seen before. While the COMEX sits frozen at $91, Asian markets do not celebrate American holidays. Shanghai is open right now. Tokyo is trading. Singapore is active. Hong Kong is bidding. The entire Eastern Hemisphere is conducting live price discovery while the Western paper market cannot respond, cannot adjust, cannot react. And what prices are they discovering? This is where it gets truly revealing. As of midnight Eastern Time, just 47 minutes ago, the Shanghai Gold Exchange was showing physical silver transactions at $103.80 per ounce. That's a 14% premium over the frozen COMEX price. Tokyo Commodity Exchange printed $102.40. Singapore's bullion market just transacted at $104.20. Hong Kong physical dealers are quoting $101.75 for immediate delivery. Let me be absolutely clear about what these numbers represent. These are not black market deals. These are not back alley transactions. These are official prices on regulated exchanges for physical metal that's actually changing hands right now. Sophisticated Asian buyers, institutions with decades of commodity trading experience, are paying nearly 15% more than the official Western price for the exact same silver. Why would they do that? Why would professional traders voluntarily overpay by 13 per ounce when they could theoretically just wait for Tuesday morning, buy on the COMEX at $91 and save millions? Because they understand something that most Western investors still haven't fully grasped. The COMEX price is fiction. It's a derivative fantasy maintained by paper contracts. When you buy silver on the COMEX, you are not buying silver. You are buying a promise to deliver silver backed by a vault system that holds 18 million real ounces against 847 million ounces of claims. That's not a market. That's a confidence game. And the confidence is breaking in real time across Asian trading floors. Asian buyers paying $104 tonight aren't buying promises. They're buying metal. Real physical silver they can hold, store, and use in manufacturing. They're paying that premium because they've calculated that by Tuesday morning, one of two things happens. Either the Western paper price explodes upward to meet physical reality, or the COMEX declares force majeure and shuts down entirely. Either outcome devastates the shorts. Either outcome rewards physical holders. Either outcome proves the paper price was a lie all along. Now let me show you exactly who is trapped in this crisis and why they cannot escape. According to Bank for International Settlements, data released January 15th, the concentrated short position in COMEX silver breaks down like this. One major Swiss bank is estimated to be sitting on approximately 215 million ounces of paper short exposure. That single institution is short more than 11 times the entire COMEX registered inventory. Two British banks hold a combined 186 million ounces short. Three Canadian institutions hold 127 million ounces, and two American banks hold 319 million ounces between them. 8 institutions. That's it. 8 institutions control 93% of all commercial short positions in the COMEX silver market. And every single one of them is now watching Asian price screens in horror as the gap widens with each passing hour. Here's the math that should terrify Wall Street right now. At Friday's closing price of $91 per ounce, the total notional value of these short positions was approximately $77 billion. These are major financial institutions. They can handle $77 billion in exposure. They've navigated that kind of risk before. But if silver opens Tuesday morning at the current Asian physical price of $104 per ounce, that same exposure becomes $88 billion. That's an $11 billion unrealized loss, crystallizing the instant the market reopens. But it gets much worse because these institutions did not short silver with $77 billion in cash reserves sitting in their accounts. They shorted silver using leverage. Based on regulatory filings and standard prime brokerage practices, the average leverage ratio on these positions is estimated between 15 to 1 and 25 to 1. That means the actual capital backing these positions is somewhere between $3 billion and $5 billion when Tuesday morning arrives and the price gaps up by $13 or more. Immediate margin calls trigger. Margin calls totaling tens of billions of dollars that these institutions simply cannot meet with available capital. What happens next is forced liquidation, forced buying. The banks must cover their short positions at any price available. That buying pushes prices higher. Higher prices trigger more margin calls at other institutions. More margin calls force more buying. More buying pushes prices even higher. This is the classic short squeeze mechanism. But what's about to happen makes previous squeezes look like practice runs, because this isn't happening in a stock that produces nothing. This is happening in a physical commodity that modern civilization cannot function without. And the vaults are empty. Friday's COMEX inventory report showed 18.2 million ounces of registered silver available for immediate delivery. It also showed 84.6 million ounces of eligible silver in the warehouses. Combined, that's 102.8 million ounces total, which sounds substantial until you understand what eligible actually means. Here's what the mainstream financial media refuses to explain clearly. Eligible silver is not COMEX silver. Eligible silver belongs to private entities who are simply storing their metal in COMEX-approved vaults for convenience and security. These private holders have absolutely no obligation to sell their silver. No obligation to convert it to registered status. No obligation to make it available for delivery against futures contracts. The COMEX can only deliver registered silver, 18.2 million ounces against 847 million ounces of outstanding paper claims. Tuesday morning. If those orders execute, and there's every indication they will, the remaining registered inventory could be completely drained within hours of Tuesday's opening bell. Not days, not weeks, hours. And then the COMEX faces an impossible choice. Declare force majeure and admit to the world that the paper silver market is broken, or allow the paper price to rise to whatever level is necessary to attract new physical supply into the registered category. Based on current mining costs, above-ground inventory levels, and industrial demand projections, analysts estimate that equilibrium price, the price where enough holders voluntarily sell to meet demand, sits somewhere between $180 and $280 per ounce. Now, let me tell you about the industrial panic that's accelerating this timeline dramatically. Silver is not just a precious metal for coins and investment. It is an absolutely essential industrial input, with no viable substitute in dozens of critical applications. Solar panels require silver for photovoltaic cells. Electric vehicles require silver for electrical contacts and battery systems. 5G infrastructure requires silver for conductivity. Medical devices require silver for antibacterial properties. Military electronics, semiconductors, and advanced manufacturing all depend on silver in ways most people never consider. Global industrial silver demand in 2025 was 687 million ounces. Total global mine supply was only 823 million ounces. That leaves just 136 million ounces for investment demand, jewelry, silverware, and everything else combined. The industrial base alone consumes 83% of all the silver mined on Earth every single year. Now here's what happened in the past 72 hours that changes the entire dynamic. Thursday, January 15th, 2026, Samsung Electronics publicly announced that it was unable to secure sufficient silver supplies for its Q2 2026 production schedule. The company stated on record that it was willing to pay significant premiums for guaranteed physical delivery. This wasn't a quiet internal memo. This was a public statement from one of the largest electronics manufacturers on the planet. Friday, January 16th, an internal Tesla memo was leaked to financial media. The memo from Tesla, supply chain director, stated that silver supply disruptions could force production halts at Gigafactory Nevada by March, if immediate solutions were not found. Saturday morning, Taiwan. Semiconductor manufacturing company TSMC, the most important chipmaker on Earth, activated force majeure clauses in 17 separate supplier contracts, citing inability to source silver at any price. These are not speculative junior mining companies making bold predictions. These are the largest technology manufacturers on Earth publicly admitting they cannot acquire the silver they need to operate their production lines. When companies like Samsung and Tesla and TSMC cannot get silver, we're not talking about investment demand anymore. We're talking about the industrial base of the global economy grinding to a halt. And what happens when trillion-dollar corporations face production shutdowns? They panic buy, they pay any price, they bypass normal supply channels and go directly to wherever physical metal exists. Reports from Asian trading desks indicate that at least 4 major electronics manufacturers have placed physical delivery orders totaling over 40 million ounces at current market prices in the past 2 weeks. 40 million ounces of immediate industrial demand. The entire COMEX registered inventory is 18.2 million ounces. Industrial buyers alone want more than twice the total deliverable supply before we even consider investment demand, before we consider the short squeeze, and before we consider what the central banks are doing. And the central banks, this might be the most important signal of all. Saturday morning, January 17th, the People's Bank of China released its updated reserve allocation data for December 2025. China added 82 million ounces of silver to its official reserves in a single month. 82 million ounces. That's more than 4 times the entire COMEX registered inventory purchased by a single buyer in 30 days. But here's the critical detail that everyone needs to understand. China did not buy that silver from the COMEX. China bought directly from mining operations in Mexico, Peru, and Russia through bilateral agreements that completely bypassed the Western exchange system. The largest buyer in the world has concluded that the COMEX is no longer a reliable source of physical metal. Think about what that signal means. And China is not alone in this assessment. India's Reserve Bank added 34 million ounces in December. Russia's central bank added 28 million ounces. Turkey added 12 million ounces. Combined, these 4 nations accumulated 156 million ounces of silver in a single month. That's more than the entire COMEX total inventory, both registered and eligible combined, purchased by just 4 central banks in 30 days. Central banks are not buying paper promises, they're not buying COMEX contracts that settle in cash. They're buying physical metal and removing it from the Western financial system permanently. This is a vote of no confidence in dollar-denominated paper silver. This is preparation for a monetary system in which silver plays a role it hasn't played since the United States removed it from general circulation in 1964. So what happens on Tuesday morning, January 20th, 2026, when the COMEX finally reopens and paper price meets physical reality? I see 3 possible scenarios, and all of them point in the same direction. Scenario 1, the COMEX opens and immediately hits limit up. Silver gaps from $91 to approximately $109, the maximum daily move allowed by exchange rules. Trading halts, margin calls issue across the system. The limit up is hit again Wednesday and again Thursday. Within a week, the paper price catches up to physical reality somewhere above $140. Short positions liquidate in an orderly, if extremely painful manner. This is the optimistic scenario that allows the paper system to survive with significant damage but without complete collapse. Scenario 2, the COMEX opens and the CME group immediately declares force majeure before trading begins. Trading is suspended indefinitely. Existing contracts are settled in cash at a price determined by the exchange, likely somewhere between the paper price and physical price, probably around $97 to $98. Short sellers escape with substantial but survival losses. Physical silver holders are denied the full benefit of true price discovery. This is the scenario Wall Street is praying for because it maintains the illusion of system stability. Scenario 3, the COMEX opens normally, but Asian buyers immediately submit standing orders to purchase all remaining registered inventory at prices above 115. The 18.2 million ounces drain within the first few hours of trading. The exchange cannot deliver against outstanding contracts. A physical delivery default occurs for the first time in COMEX history. The exchange is forced to halt trading and declare force majeure after the fact. Confidence in the Western paper commodity system is permanently and irreversibly destroyed. This is the scenario that changes the global financial order. I cannot tell you which scenario unfolds. Nobody can predict exactly how the next 36 hours play out with absolute certainty. But here is what I can tell you based on the data. All three scenarios result in silver prices dramatically higher than current paper quotes. All three scenarios result in catastrophic losses for short sellers. All three scenarios validate the decision to hold physical metal outside the banking system. We are now deep into the 72-hour blackout. Less than 36 hours remain until the COMEX reopens. 36 hours until paper meets physical. 36 hours until the 46-to-1 leverage ratio faces its reckoning. 36 hours until 8 institutions face billions in potential losses. 36 hours until the $104 Asian bid becomes impossible to ignore in Western markets. You cannot print silver. You cannot create it with a keystroke like fiat currency. You cannot satisfy Samsung and Tesla and TSMC with paper promises and cash settlements. You cannot meet Chinese and Indian and Russian central bank accumulation with fractional reserve vault inventories. The fundamental disconnect at the heart of the paper-silver market is about to be exposed in real time. Monday night, January 19th, 2026. Remember this moment. Remember where you were when the 72-hour blackout was coming to an end. This is untold empire. The clock is ticking. The vaults are empty. The shorts are trapped. The industrial buyers are desperate. The central banks are accumulating. And the blackout is almost over. By Tuesday morning, the world will know whether the paper-silver market can survive contact with physical reality. The only question is whether you positioned yourself on the right side of what's coming. The countdown continues.